Round and search. True traders react to the market.
Hi guys, this is Kelvin here from Round and Search. Do you know indicators are subdivided into leading and lagging indicators? If the indicators that you are using doesn't give you a consistent, accurate measurement, it might be because of the indicators that you are using is not a leading indicators but a lagging indicators. Before we start the explanation, if you want to open a trading account with a brokerage rate as low as 0.08% or 8 ringgit, whichever is higher, and wish to join in my weekly market POV, go to the link in the description box to sign up for new trading account. Indicators are commonly categorized into trend, mean, reversion, relative strength indicators, momentum, and volume indicators. But within these indicators, it is subdivided into leading and lagging indicators. Leading indicators is to try to predict the price movement based on the historical data. Lagging indicators shows the current price consequences from historical data. If you want to find what is the current trend, you should look at the lagging indicators and apply leading indicators if you want to measure the future price movement. But many investors and traders didn't understand the differences between leading and lagging indicators. That's why many investors are using lagging indicators to time their investment entry, such as moving average and Bollinger Band, which is not an indicator to help you to decide the entry and the exit. There isn't one indicator that fits all. As an investor or traders, we need to have mental sharpness to identify the changes in the trend and know when to apply the right indicators. Here are the basic steps as an example to show you how and when to apply the right indicators in the right trend. So step 1, you need to identify the current trend using the lagging indicators. Step 2, select the indicators that works well for the trend from leading indicators. Step 3, identify the possible changing of trend from lagging indicators. For example, using moving average lines as lagging indicators to identify the current trend. When exponential moving average and short or mid-term moving average lines are far apart, it is showing the sign that the stock price is in an uptrend or downtrend. So in this case, RSI and stochastic oscillator or any indicators that measure overbought or oversold will not work well in an uptrending or downtrending stock. It is because the indicators will often be sticky towards the overbought or oversold area, and the price retrace from the overbought or oversold area is not significant. This will reduce the indicator's effectiveness, and it is the reason why you always find why these indicators sometimes work well and sometimes are not effective. When it is an uptrending or downtrending stocks, one of the indicators that you may apply to measure the entry and exit timing is MACD. When we analyze MACD, we can use the MACD histogram to find the changes in closing price that start to get narrow, which is the green bar, and also in the negative zone. However, based on our observation, the retrace signal in MACD is still 1 to 2 days lagging compared to price and volume signal, which will affect the late measurement for exit. That could cause a lower profit or even break even in gross, because MACD histogram becomes shorter than yesterday at the positive zone when the price closes lower, which will cause investors and traders to miss out some of the profits. When exponential moving average, short and mid-term moving average lines are squeezing together, showing signs that the stock price is moving into a sideways trend. This is when we can apply RSI like stochastic oscillator. From the chart, stochastic overbought and oversold provides better measurement on the short-term price reversal than a stock is in the up or downtrending. But the actual application for stochastic is not making decision based on the oversold or overbought area. The first step to identify whether to execute trade is to identify is there any divergence. Then you react to it based on oversold or overbought. We will cover this stochastic application in our next video. So if you want to know more about how to use stochastic more effectively, do subscribe to our channel and turn on the notification bell to get notification when we upload a new video. Price fluctuation is important for traders and investors, especially to those who use traditional technical analysis and indicators, because the signal for entry and exit are often lagged. Therefore, you will need to have a higher volatility in the price in order to capture the profit. Otherwise, if you know how to analyze the big boy's intention with transaction data, you can still make small profit from a price fluctuation, because the entry or exit is often lower or higher than the lagging traditional analysis. Do remember the steps below when you are choosing which indicators for your analysis. So the steps 1 will be identify the indicators type, leading or lagging. Step 2, apply indicators that helps you to identify trend. Step 3, select the right indicators for the trend. Step 4, watch any possible changes in trend and react accordingly. And step 5, repeat the above. Hope this video will help you to understand better in indicators application. If you find it helpful to you, please give us a like and help us to share this out to more traders and investors. See you guys next time.